If you're taking out down payment assistance to purchase a home, under no circumstances should you do a temporary interest rate buy down. If you're looking at down payment assistance and to do a temporary interest rate buy down, your lender is going to set you up for failure. So I am specifically talking about down payment assistance programs where you owe the down payment assistance back. And we're talking about temporary interest rates. Let's just pretend that you have a 1-year buy down. So that means that for 1 year, the seller gave you enough money to be able to subsidize part of your mortgage payment. So your interest rate's really here, but your portion that you're going to pay every month is equivalent to 1% less. Okay, so it helps you save a little bit of money. The problem comes in that, and a lot of people really think that interest rates are going to come down in 1, 2, or 3 years. So if you're purchasing a home and you're doing temporary financing to reduce your monthly payments, as you believe that there's going to be an opportunity to refinance to a better rate later. In a down payment assistance scenario, you owe the money that you borrowed to purchase your house. When you change the first mortgage, that means you're changing that loan. Guess what's due? The money that you borrowed for the down payment. It's due in full. Typically, most people haven't had an opportunity to save the cash to be able to pay that off. So a lot of people will use the equity in their house. However, here's where it's going to bite you in the ass if you do a temporary buy down. When you borrow money out of your house, this is now cash out refinance. It's not just a straight change of your interest rate. You are taking cash out of your house. There is a totally different set of rules that you need to follow. And one of the big rules is how much is your house worth versus how much you owe. Let's just play devil's advocate and say in 14 months from now, you refinance. In 14 months from now, if we look at average appreciation, your home might have gone up about 4.88%, which is awesome. That's equity. It means that your home is appreciating in value. But in order to refinance, taking cash out of your house to pay off that down payment money that you owe, you need to have a gap between what you owe and what your home's worth. And that gap needs to be 20%. And then whatever cash you're taking out, you probably aren't going to have created enough equity in your house to create that huge gap in value. That takes years to create. Here's what I suggest instead. When you have down payment assistance and you're pairing that with some money from the sellers to help, there's 3 really cool buckets you can put that money into. One thing you can look at with your lender is, if I take a certain amount of money from the seller, what kind of interest rate can I buy my loan down to? The second way is, of course, covering your closing costs. The third super cool place that you can actually use that money is to help reduce what you owe on the mortgage. So when you take out a FHA loan, is they charge everybody that gets an FHA loan 1.75% of they take that money and they dump it on the top of your mortgage. So what you can do is you can use some of the seller's money to actually pay off that upfront mortgage insurance cost. That's a way smarter way to navigate affordability when you're purchasing a house and using down payment assistance.